Today's market call is presented by Robinhood. Robinhood's financial tools put you in control to trade, invest, and earn your way. A frosty January 7th here on the East Coast, 1 o'clock on the East Coast, the aforementioned market call. Swizzle, Dan, Nathan, the audience together. Hi, Dan.
What's going on with that head of hair of yours, man? Because it's pretty interesting. I know we're going to get a lot of questions in the chat.
They call this a mohawk.
Yeah, people get in there and see what Guy should be doing with that head of hair. By the way, you mentioned frosty. Guy, you always get frosty when you see me wearing one of the Wall Street vests like I'm wearing right now, and you just look like way underdressed for this weather. I'm just going to give it to you right now. But you're looking good.
I mean, apparently it's without. I just saw that we're changing the name of the Gulf of Mexico to the Gulf of America, and what I put on the Twitter is, if he was really creative, he would call it the Gulf of America, GOLF, and then build courses all through the Florida Keys. It'd be effing genius.
Yeah.
But that's not what we're here to talk about, Dan. No. We're here to talk about the market.
Yeah, I don't know if you mentioned this, and you guys got to go check out our main man, Doug Katz from Seabreeze Capital. He's a prolific writer for TheStreetPro.com. He laid out a pretty cogent reason why we might see a market top here in January of 2025. Lots of good stuff there. But, Guy, I think at the crux of that is what's going on with rates. And this is something that you've been talking about for a while. You've been on like a lonely island.
Yeah, I like being on an island. You know what? I'm fine with it. It's like Darrell Revis. He used to be out on an island. And
Revis Island.
Sure. He was tasked with covering the stud wide receiver of the opposing squad. And I have no problem with that as well.
Maybe it was Randy Moss. Who knows?
Exactly. The Randy Mosses of the world, the Ocho Cincos. But what you learn when you're out there on the island is every once in a while you're going to get burned, but you have to have a short memory. And, I say that actually half in jest, half serious, because it's true with what we're trying to do each day as well. And there are going to be days that you look like a complete jackass, which is, par for the course for me. And then going to be other days where things start to sort of play out the way you sort of thought they would. And I'll say this for about the 100th time. There are people out there that mistakenly believe that somehow the Federal Reserve controls interest rates. They do not. And if you ever needed proof positive, look at this chart. Look at where we troughed in terms of yields. It was September of last year. Think about when the Fed started to cut rates. It was in September of last year. And since that time, rates have gone up over 100 basis points now, given where we're trading. That is astonishing, and I think it's caught a lot of people by surprise, and a very one-dimensional way of thinking. If the Fed controls things, rates should be lower, but the exact opposite is happening. And I think it's happening for some of the reasons that I've been concerned about for a while. And I'm not saying I'm some great prognosticator here, but you start to read the tea leaves and say, there's a problem with rates going higher. It does not suggest that the economy is doing that much better. It suggests something else. And, there have been a couple days over the last month, 2 months, where the market has picked up on that, but it's only been a couple days. Now, maybe today is the start of something. Maybe magically 470 is the level that people are going to get concerned, but I think we're right to start the show with interest rates, Dan.
Yeah, no doubt. And by the way, we're going to get to some questions. We're also going to have a couple trade ideas. We're going to look back on a trade idea in the XLE that we kind of detailed using a call spread in February expiration. We're also going to look at a name that Guy is starting to kick the tires on. That would be the ExxonMobil. Obviously, it's the largest component within the XLE, but we have a kind of short vol trade there that I think lines up pretty well, especially with some of the technicals, Guy, that we're looking at. But to your point about 4.7, okay, and I think we made this point yesterday on Market Call, and if you were to overlay the 10-year yield versus the S&P 500, you see when late 2023, when we kissed that 5% 10-year, we had an S&P that had been actually selling off, okay, opposite of what yields were doing. And the S&P, I think, was, it got close to 4,200 or something like that. So here we are, just south of 6,000 or so. If we are on our way to 5%, and this is what Doug kind of lays out for a whole host of other reasons, we can talk about valuation of the S&P versus that of, we can talk, we've talked about equity risk premium. Doug's done a great job with that. But we're getting to a point where things kind of look unsavory, Guy. And I am not starting out 2025 as a raging bear. I'm just not. I'm going to try to find some things that make sense, whether it's sectors. We talked about this yesterday on the tape and on Market Call a little bit. But, someday soon, this is going to matter. The thing that you're talking about here with yields, when people finally get to the point that higher for longer is a thing. Because, 2022, when we started selling off in late 21 into 2022, I think a lot of folks, what were they pricing in as far as rate hikes? 3, 4, 5, you know what I mean? And we got up to 4.5% in the Fed funds rate.
It's fascinating, and I think your point earlier about where the S&P was the last time rates were sort of approaching these or through these levels on the upside. And Amanda can throw up an S&P chart over that same period of time. I mean, you can see it for yourself. We were decidedly lower. Now, it's not one for one. We're not suggesting it's just that simple. There are obviously other factors at work, but rates to me are one of the biggest factors, if not the biggest factor, in terms of trying to assess where the market is in terms of valuation and what the headwinds or potential tailwinds are. And higher rates suggest they're going to be significant headwinds for a lot of these names. And, you're looking at that chart now. I mean, that overlay right there. I mean, in the fall of 2023, you had an S&P, to your point, Dan, which was, just north of 4,000. And it's been basically lower left, upper right ever since. And I don't think either one of us is suggesting that if we were to get to 5%, we'd beeline it to 4,200. But I do think there's an inevitability to trade down to the 150-day moving average. And then we're going to start having conversations about, what is this year setting up and what are people really looking for? And can we see 14% earnings growth? And do these valuations make sense against this backdrop of higher rates? And oh, by the way, there are a lot of other things going on. And again, not getting political, although I started with that little bit of a jab. I mean, obviously, it seems like the incoming administration might be digging their heels in a bit on the tariff front. And maybe as much as people thought it was a negotiating tool, maybe it's part that, but maybe there's some truth behind it as well. So, the market's coming to grips with a lot, and it's seemingly coming to grips with it today.
Yeah. So one thing I'll just say is on the yield thing and then on the dollar. So if we could pull up the Dixie, the US dollar index, I mean, we see what's going on. We know that, some of these other currencies are very weak, especially Japan, China, but the Dixie is largely made up of, stuff ex Asia, right? When we think of the euro and probably the yen in there. And, when you think about this and you think about what you just said about 14% expected earnings growth year over year, that's per FactSet, you have to say to yourself, at what point does the strong dollar weigh on US multinationals? What point does higher yields kind of weigh on smaller cap stocks? A lot of folks have been waiting for that trade to kind of kick into gear. And if we can just pull up the Russell 2000 for a second, that was one of the early beneficiaries right out of the gate after the election, but then gave a lot of it back, right? And so when you think about that, because a lot of the policy was meant to be, or at least was thought to be, it was going to be inflationary. Look at that. It filled in the entire gap. And now it's sitting right there on that 150-day moving average. So from a technical perspective, it looks bad. It acts badly. And so to me, if you're waiting, and Doug's been talking about this for this broadening out, it ain't happening. It's still in the hands of the fateful 8. And when I see every other day up 1.5, down 1.5, up 1.5 in the NASDAQ, it tells me the volatility bands are widening. I just want to pull up the VIX here for a second, Guy, because this is something that you highlighted yesterday. We have a 17 plus VIX right here. You saw that spike right after the Fed meeting in mid-December. I think it was December 18th. We had that really unusual spike in that August 5th downdraft here. You said yesterday you think it's going to be a thing. Give me your take on the VIX, and then I'm going to give you a little bit of what the SPY is pricing as far as volatility terms between now and the end of the month when we do have the next Fed meeting.
Yeah, I mean, I don't want to get too in the weeds on this one, but something I've thought for a while in terms of the VIX is the dampening effect that Fed policy historically has had. And people have come to the realization that, although the market can go down for a day or two, it doesn't stay down. And with that said, there's no reason to be buying volatility under those circumstances, because historically that's been a bit of an insurance policy. And not only you don't have to buy it anymore, you can actually start to sell it and create a synthetic dividend for yourself, which I do think a lot of people have put in place. And you saw how painful that could be back on August 5th. And to a certain extent, you saw it in December 18th and the 27th. But I think as rates continue to go higher, I do think this is going to be a year where volatility surprises people on certain days and periods of time to the upside. And I'll stand by that. And I thought that, by the way, as we got into the summer, and that proved correct, obviously, in early August. I was surprised how quickly it came back down, but I don't think the whole vol trade is over. And I do think there are going to be people out there that are going to start to take advantage of these depressed volatility levels and look to actually play vol from the long side. So my point is, I don't think that Fed put is in place the way it was before. And I don't think, although the market might think there's a safety net below them, I think there's anything but a safety net. And I do think volatility is going to be a thing. And by the way, we mentioned the dollar. John Hutton asked a question about he'd love our thoughts on the U.S. dollar. And so if we quickly pull that dollar chart up again, you know, what I think could be really interesting this year, Dan, and this is going to be completely non-consensus, but, you know, the dollar clearly has been strong. I get it. But this is also a past president, incoming president that has openly talked about his want for the dollar to actually be weaker, and the dollar was too strong, which, if you think about it, sort of flies in the face of what you would think. But, you know, in terms of the amount of debt we have and the problems we have, it actually makes a lot of sense. So I think this is an incoming administration that might openly talk about the strength of the dollar and not wanting to see that. And I think the dollar weakness is something this year that could surprise people. So you could have a scenario which economically doesn't make sense, and historically in terms of the math doesn't make sense, but rates continuing to go higher, and a dollar that actually starts to give a little bit back, which I think opens the door for gold and some of these other trades we've been talking about. So John Hutton, that's my quick 2 cents on the U.S. dollar, Dan.
Yeah, I mean, my sense is that if you think, Guy, that rates are going to continue to go higher, maybe establish a new range above that 5% or so, I just don't see the dollar coming in a whole heck of a lot. When I think about the dollar strength, I think about yields going higher, and I think about the potential for that 14% earnings growth that is embedded in the S&P 500, which is within a couple percent of its all-time highs. That is a cocktail for higher equity volatility. And it also sets up a scenario where if there's any surprises out of the Fed, you know, we have that Jan 30th meeting. If there's any surprises out of the fateful eight and what they have to say about CapEx, what they have to say about uptake of all this capacity that they have built out for all these other industries, right, to kind of rent the compute as it relates to generative AI, we're going to get a good sense of all of that in the next few weeks. And, you know, let me drive here for Amanda. Let me go to the Robinhood legend, Guy. I'm going to be a legend here for a second.
Well, I mean, why wouldn't you be?
Why wouldn't I? So here's the thing. Here's my main page, right? And this is how easy it is to kind of click through this thing. I have the SPY up here. So I'm going to go to the SPY. Let me change this thing. I'm going to go to a 1-year chart here. You see that rising 150-day moving average. That's been a nice uptrend. You see us grinding right here. So, you know, like we highlighted this point about the volatility bands kind of widening. You know, here's a 3-month chart, and you just see those daily moves. They're much bigger than what we've seen, you know what I mean? Like on that kind of slow move higher that we saw in November, you know, post-election, that sort of thing. And you have that huge move right after the Fed meeting. Well, when I think about the SPY, I like to price up what it's implying right in and around events. So we know that last week in January, it's going to have that Fed meeting on January 30th. It's also going to have a whole host of the fateful eight of their earnings, right? And so again, that goes back to what do they have to say about CapEx? What does earnings growth look like? What does the current guidance look like? What can people impute about 2025? And I think if there's any disappointments there. So here's how I figure out vol and what the expected movement is. I'm going to the options chain here. So I'm going to click on January 31st. It's not a regular expiration. We know those are the third Friday of every month. So here it is. It's trading about 592, right? So I'm going to kind of go to this 592 strike, Jan 31st, and I'm going to look at the call premium. That's about 944. I'm going to look at the put premium. It's about $8 here. You put that together, you get to about 17 and a half. How do I figure out the implied movement in the SPY? I take that 17 and a half premium. That is the at the money straddle. Okay, the call premium plus the put premium, and I divide by the strike, 592. It gets me about 3%. That is the implied movement between now and January 31st. And we have all those catalysts, and we also have an environment where the volatility bands are widening in the index a little bit. We're starting to see some, and we're going to get to some of these big names and some of the moves that we're seeing. And I say to myself, okay, if I'm looking for put protection over the next few weeks, it costs me 1.5%. That's half of the implied movement. It's half of the straddle. That looks pretty reasonable if you think about that, Guy. We could get 1.5% in a day.
In 100%. And, you know, the skew works to your favor on this one as well. If you just look at in terms of the call put skew, which is, you know, probably coming in a bit, but it's still obviously skewed towards calls. People are willing to, in other words, people are willing to pay more for the calls at a certain level than they are for the puts, which, has made sense given what the trajectory of the market's been. So you got that working for you as well. And, I agree. There's still some runway left to the end of the month. And I don't think it's crazy to think we could see a move of that magnitude. So to me, that's something, that makes a lot of sense, especially given some of the things we talked about. We haven't even mentioned Nvidia yet today, but we will, obviously, because we're not trying to bury the lead, but that's one of the leading stocks today in terms of what it's done and what it's done today and what we've seen over the last year or so historically.
Yeah, we definitely buried the lead, guy. Just one last thing before we get to some of these big stocks here. Look at the CME Fed Funds tracker. And, when you see this sort of thing, right, you see that 93, 94%, I think it's 95, 96% probability that the Fed does nothing at the next meeting. Okay, they leave, the Fed Funds rate at that 450 on the upper band here. That's the sort of thing that, when you have near certainties priced in, you know what I mean? What are they going to say about March? You know what I mean? Like, those are the sorts of things that can cause volatility. And I think people are going to remember that deck 18, that reversal day. All right, dude, what do you want to do here?
Real quick, we have a question I want to just address, because what I'm going to really try to focus on this year is to get, insert these questions at the right time. Spunky Space is asking, nice. Will the United States, I know it's a great name, will the United States megacorps be okay with a weaker dollar? Is that why Trump will kick them lower tariff rate? So the short answer to this question is, historically, a weaker dollar creates a tailwind for U.S. multinational, because our goods become more attractive vis-a-vis that weaker dollar. By the way, I also think that's something that former President Trump, incoming President Trump, understood in his first administration, and I think it's something that he will embrace in this next administration, which again flies in the face of what presidents have said since Roosevelt in terms of their want for a stronger dollar. But when you have, debt to GDP ratios that we have, you don't want, it's one of those things. When you owe somebody $100, you have a problem. When you owe somebody $36 trillion, they have a problem. And, the way to get out of that problem is obviously to sort of weaken your currency, which makes it, it's a nefarious way to sort of get around the problem that's been created over the last decade or so. So again, that's apolitical. It's just factually true. Dude, so it should theoretically be a tailwind for multinationals.
I love that. I love that saying. It's so somebody who has lots of vowels in their last name. You know what I mean? It's such a great saying. I mean that. I couldn't get away with it. I don't think I could get away with it.
What's that? What did I get away with?
When you owe somebody $100, you got a problem.
Like that?
When you owe somebody $36 trillion, they got a problem.
Well, I mean, if you think, there's a lot of truth to that, and I think, I love it. This is an administration I think intuitively understands that, and has historically used it to their benefit in business. And again, this is not casting judgment. This is just speaking factually, and I think they're going to try to implement similar in this scenario. And again, what I think it means for yields and those types of things, and we'll see what it subsequently means for the market. But let's continue on our merry journey, Dan, as we go from Fed funds rate to, you talked about the implied move and how you got there. Yesterday, we teased the XLV. So let's take a look at that, which has not been a performer at all. Today, we get in a bounce, but, this has not been good.
Yeah, this is one where, listen, you see that sustained sell-off. There was a lot of groups that kind of maybe ran into the election, maybe popped out after this one. This one was just, I don't know why it was rallying in early September, but if you look at that sustained sell-off, just a series of lower highs, lower lows, that sort of thing, it's kind of consolidating here near those 52-week lows. To your point, it kind of busted out. I think you and I talked about this one a little bit yesterday. Maybe you see a move back towards that kind of 148, 149 level. We'll take a closer look at this one. We'll see what call spreads look like. Maybe we'll look to sell a put spread here and play for kind of a move towards those recent highs. I don't know. We just wanted to flash that one because, again, this was a very out of favor group late last year, Guy. I know it's the group that you track fairly closely. We also know that a lot of the sentiment, the positive sentiment around the GLP-1 trade, which was Novo Nordisk and Lilly, has kind of come out of it. So you either have to see some excitement come back into those and maybe some other names that are going to get some approvals on some of the drugs they're working on in the space, or just have some sort of interest in the relative valuation. We know that Lilly got really expensive relative to the other one. So maybe there's some interesting names that you could play through the XLV.
Well, that's it. I mean, what works for these, excuse me, ETFs on the way up when these stocks, these individual stocks. I mean, Eli Lilly's probably 12% of the XLV. I think J&J might be 9. So, I mean, you're talking about 20% or 2 names. But as those names obviously then go the other way, you see how quickly you get a drawdown. But with that said, that creates opportunity in some of these underlying names. And for example, Merck, which has found a home around $100-ish, having traded up to about 133 at some point last year, that's getting a little bit of a giddy up here. So, when these ETFs sell off, the same way when they go to the upside and their money flows, it drags everything up with them. And we've had that conversation. Well, the same thing happens the other way. When these ETFs get sold off, it's not just 1 or 2 names, it's the entire space that sort of falls victim. And I think to a certain extent, names like Merck and TMO have sort of found themselves under the auspices of that. But you're right to point out that sell-off creates opportunity, maybe not necessarily in the ETF, but in the individual names in the ETF.
Yeah, no doubt. Another group that I think is interesting and relative to the dollar strength, let's just pull up staples really quickly. XLP, we know the largest components there at Procter & Gamble. I mean, look at this thing. Obviously, it's broken that uptrend that was in place from the spring, and really looks like, trying to kind of buy this thing as you're catching a falling knife. I mean, maybe you see this thing back towards $75 in that kind of consolidation range, Guy, from the spring or so. But and just before I get your comment, let's just pull up Coke and Pepsi. I mean, these things look like unmitigated disasters. So, Guy, this can't just be about higher yields. It can't just be about a strong dollar. Or am I wrong? Is that
no? That's a big part of it, without question. I think another big part of it, and I know this is what's happening on the GLP-1 front, without question. I also think a big part of it is, again, not being political at all, but with potentially Robert Kennedy coming in on the fray. I mean, he's clearly somebody that wants to focus on health and the foods that people eat. That does not bode well or augur well for names like Coke and Pepsi. And I think, you could say you're nuts, but I think that's part of it as well. So when you sort of throw all those 3 things together, you have the price movement that you've seen. Now, at a certain point, they're going to find a home in terms of valuation. I just don't think we're here yet. I mean, I'm more inclined to look, for example, this is the XLP. I know it's sort of nitpicking a bit, but if you go back to sort of the March high of around 76, that's the sort of level that I think we could sort of trade down to if you want to draw that horizontal line, Amanda.
Yeah, that makes sense. All right, let's go to the Fateful 8, Guy, because this is obviously...
Was that a movie?
No, it's the Hateful 8. So
I see what you did. I see.
You want me to remind everybody what's going on here? That Mag 7 thing was really bugging me. And let's be honest, I think on Fast Money, we changed the Magnificent 7.
I don't think I've ever used, me. There's certain things I just refuse to say.
I think Kramer, he coined it. And then it was Magnificent 7. It doesn't really roll off the tongue. And I think on Fast Money, and this is a little inside baseball, one day, I think it was like about a year ago, Mel in a break was like, I don't want to say that anymore. I don't like that. You know what I mean? That expression. Does that mean that these are magnificent stocks and they're going up much higher, this and that, whatever? And so I just kind of started referring to it as the Mag 7.
Yeah, sure.
I think, oh, come on. Don't. All right.
No, I just said, yeah, sure. That's right.
Remember in 2017, when I coined, everyone was talking FANG. It was Facebook. It was Apple.
I remember when then President Trump pulled out a one of those things called and started writing down all the $1 trillion companies.
And I had already
basically copied what 100%.
I
guarantee somebody said to him, "Hey, you should take a look at this." And I'm giving you kudos. I mean that sincerely.
Who just said it's the Microsoft, the Apple, the Google, and the Amazon.
Yeah.
And he busted. All right. So I coined that. I'm not proud of that. Okay. But I coined it. Now, what we've done with the Fateful 8 is when Broadcom, that comes out AVGO, moved above that $1 trillion mark, we threw that in there. And the whole idea, what does fateful mean? Okay. Well, fateful means, you know what faithful means. Okay. It's not faithful. Karen on the Fast Money said, you faithful? No, that would mean you have faith in these stocks to continue. Faithful means that the fate of the market is in the hands of these 8.
Oh, much different word. I mean, it's entirely different word. I mean, there's no I in fate.
No. There's not. All
See
right,
what I
let's
did
talk
there?
about a couple calls of the day, Guy, because it's 2 of the fateful 8. What is 2 out of 8? You can do
That
that
would be
math, right?
25%. So you
Yep.
take 2, you go 8
Yeah,
divided by 2, and you get 4, then you get 4 divided right.
right.
So it's
Okay,
25%.
so let's look at
You
this. So
low you gotta sorta whittle it down
yeah. So
until
so
you can't whittle anymore.
so a lot of our listeners, our viewers, they may not know Moffett-Nathanson. You and I know Moffett-Nathanson. These are 2 gentlemen that are really, really
Did you know
astute.
who Mary Ellen Moffat was?
Oh, yeah, from, Mary Ellen Moffat. What movie? Oh,
Doug
uh,
Cass
from
knows.
from Jaws.
Yeah, of course. Mary Ellen Moffat, she broke my heart. Remember when
Yeah,
Hooper opens his shirt and then
yeah,
Brody says, "You're wearing a sweater," and he goes,
yeah.
"No, Mary Ellen Moffat, she broke my." Anyway,
Are you
sorry.
ex yeah, I got that. So Moffett-Nathanson, 2 and I know these guys, they've been on the show, great guys, really smart guys. They've been doing it for probably 35 years. They downgraded Apple. That's not something that you see too frequently, okay? Their target is now $188. You see where the stock is, it's what, 240,
Mhm.
243. The average price target on this thing is $250. And so when I think about this, and obviously I'd love to get your take because this is a stock that I think we talk about daily. You say to yourself, "Oh, I don't see too many downgrades." Well, maybe Amanda can flash this up for a second. Apple has the least amount of buy ratings on the stock, and as long as I can remember, I think it's about 65% of the analysts that cover that. Look at some of these other names in the Fateful Eight. I mean, analysts are just all in. Why do we care about this? It's not important. I mean, listen, they downgraded the stock today. It's down less than 1%. It's down less than the S&P 500. It's about sentiment, right? So if there is some sort of situation that causes the, investors to kind of reprice, maybe it's just been all appreciation, multiple appreciation, and you get a guide down. Well, you're going to have analysts downgrade the stock, and then you're going to have a lot of investors who are just kind of following all this stuff on the way up. They're going to start to sell. So when you get the combination of annual analyst downgrades and investor sentiment kind of turn, that's what's important to me. And so speak to that, Guy, a little bit when you see this sort of concentration, not just in the market, but it's also the analyst community, how they're thinking about these stocks.
There's no question that you're right to bring this up as well. And Danny talks about it. Carter talk. A lot of people talk about how the market is skewed to be bullish, and I understand that. And by the way, I think it's 67% of the time the market goes up. So if you're playing the game, you're playing the odds with this. But in terms of a call like this out of a Moffett-Nathanson, I mean, you can agree with them, you can disagree with them, but you got to pay attention to it. Now, you're right to talk about sentiment around these things. And, when it swings violently, and it typically swings, not towards the end of something, but, smack in the middle of it. And I think it's interesting to point out this Apple downgrade. And, we've been quick to point out, and again, I didn't realize fully the impact that passive had, but when Apple's in almost 500 ETFs, and we've talked about this, 425 of them have Apple as a top 15 holding. Money flows in, Apple wins. But there's that old saying, Dan, live by the sword, die by the sword. And they've been living by the passive investing sword, and they've been doing really well. But that has a flip side as well. So if the market were to ever sell off for whatever reason and passive becomes active, I am here to tell you Apple will not be spared. And what works for them on the way up will work equally bad for them on the way down. And typically, as you know, things go down a lot faster. And you think about that price target. I mean, that is a significant decline from where we're currently trading. And then you have to ask, what would the broader market be doing under those set of circumstances? So interesting call from them. You can do the math around it and say, what, historically, given where their earnings are and given where their revenue guidance is, I mean, that valuation is not unrealistic if it were to get there. So
Yeah,
that's my 2 cents.
let's just stay on the chart here, guys. So that move, you see that consolidation that we saw in early November, the stock just kind of, went parabolic. It broke out, to that. You saw that double top from, the spring into the fall. That move was really unnatural, in my opinion, Guy, from about 227 up to about 260 or 257 or something, I think was the high. And, at the time, all the data points that were coming out about iPhones and about smartphones in general were not good. You know what I mean? And then some of the guidance that we heard from some of the memory guys and some of the foundries and the like. So it wasn't good. So the fact that the stock is sold off makes perfect sense. Does it find some support at that intersection of the breakout level and the uptrend that's been in place? Possibly, but you look at that 150-day moving average down there, Guy, it's about what, 227 or something like that. That seems like it could easily be in the cards. The stock doesn't report, or the company doesn't report, I think, until Jan 30th. So that last week we were talking about that. I just don't see how they guide higher. When I think about artificial intelligence or Apple intelligence or whatever they're calling it, it's just a zero. There's nothing there, right? And so as we get further into 2025 and some of the rumors about new iPhones that are coming out, you're just not going to upgrade your 3 or 4 year old iPhone in front of what's going to be a new form factor, right? So a new look and feel to the phone, and hopefully better integrated, AI, right? So I don't think this upgrade cycle is coming. That's been my view since June 10th at the Worldwide Developers Conference, but I was really wrong since then. The stock closed that day at 193. Look where it is right now. I think I've been right on the fundamentals, wrong in the price action. So that makes me RONG.
No,
wrong.
but look, I mean, it's interesting. The fundamentals haven't changed. Well, the only thing that's changed is price. And in our world, to your point, you can be right on a lot of things, but if you're wrong on price and if you're wrong on timing, you are wrong. But if it would be one thing if the fundamentals around it changed, the fundamentals around it have not changed. As a matter of fact, all the stock's done has gotten more expensive. And with each passing day, sort of the bloom continues to come off the rose in terms of this whole AI integration that was so ballyhooed in the middle of the summer, early in the summer. So we'll see how it plays out. But, I do admire this call. And they might be dead wrong, but there are very few people out there that are willing to make a call as bold as this, that are not just designated short funds. I mean, these are obviously, people that play it straight down the middle. And when you make a call like that, I mean, say what you want. I mean, they could have put a $350 price target on Apple and it goes down to $200. Nobody gives a shit. But you put a $188 price target on it, and if it goes to $300, the calls from the cheap seats are vociferous and long lasting. And I think, they understand that, and they did it anyway. So good for them.
Yeah, before we get to the options trade, let's look at one other bold call, also a downgrade. This would be in Tesla. They go, this is B of A. They go from a buy to a neutral. They did increase their target.
Well, yeah. I mean, that's
from 400. Hey, listen, good on them. They've had a buy. They had a $400 target. It overshot that, so they still see 19% upside. This FactSet average is still well below. And this is one of the things I think is really interesting, Guy. So we just talked about the breakdown of analysts on the buy side, 65% for Apple. Look at this for Tesla. 47% analysts have it as a buy, 28 have it a hold, and 25 have it as a sell. I have not seen a stock that has performed like this over such a short period of time, where there's so much, uncertainty by the analyst community about where this stock would go. Now, no one expected this thing to go from 250 to 450 in a straight line, but it's since come back nearly 20%.
Yeah. Go back to that prior slide and just see. I mean, I think 120 is the low on the street. I think 5 and change is the high, and 528. So I'm right. I mean, you think about, you could drive you could drive one of those horrible, cyber trucks through that range. And we know what that speaks to. It just speaks to people, some people looking at the company one way and other people looking at it an entirely different way. And, that's why it's such a fascinating, when people want it to be a car company, it's a car company. When they report deliveries that were disappointing, it's no longer a car company, it's something else. So their ability to be a chameleon in this environment, I think, is really interesting. But at a certain point, fundamentals and valuations matter. And, you can talk about all the total addressable market and robo-taxis and all those promises in the future. Those are still promises. They have not come to fruition at all. So, label me a skeptic here. And I do think this is one, although, it got down to sort of that 380 level, which made sense. We talked about it on Fast Money and bounced. The next time down, it's not going to hold.
Yeah, I think there's a good chance. Again, I take the over every single time about when they're going to deliver on the things that they mentioned. I think the fundamentals are still really bad. I think there's a pricing issue. There's a price war. I think they have a China issue. I think they have an EV credit issue. I think they have a competition issue as it relates to like BYD in Asia and the like. So to me, you better be valuing this on Robotaxi, and you better think Robotaxi comes sooner than many people think, because I think the fundamentals are still really bad. And I just want to make one other point, and maybe any listeners who's tracking this, a large percentage of their sales over the last few years have been leases, right? And especially before rates started going up. So at some point, you're going to sunset. Those leases are generally 36 to 40 months or something like that. Those cars will not be purchased by the leasers. I'll tell you why. You're 3.5 years into that battery. There's no reason why you would buy that car. You just turn in the keys. And if a lot of cars are put back to Tesla, okay, because they are the financer, when you have GE Finance Corporation, when you're buying a GM cars or a GM finance they take possession of the car. They figure out how to sell them to Hertz and Avis and this and there, whatever, or put them in, in the secondary market or whatever. Tesla, if they take possession of all these leased cars, that's going to put pressure on the secondary value of these cars. And that's one of the issues that's been hurting the cars at point of sale and the new one. So I think this thing is going to be a mess this year. I know that you guys have thought that I've been that way, but until maybe Amanda can show us a 5-year, this thing traded like what until very recently.
Mm-hmm.
This stock had topped out in late 21 at 400, and 3 months ago it was trading at $250. Massive performance. The Nasdaq.
What's interesting is, as loud as a lot of people were about interest rates, nobody was louder in terms of the pain that higher interest rates were causing than Elon Musk back in the fall of 2020. You can go back and remember and what he was talking about, how higher interest rates were not helping his business at all. So, that turned out to be the peak in interest rates when he started jawboning. I'm not suggesting there was causation, but as rates reapproach those levels, this does not work to their business model, which is also a bit of a headwind. Real quick, because I said I want to get some of these questions in, and we got a trade coming up, so I'm sorry. But Situation Room with Wolf Blitzer asked about Micron, and I'll tell you something. I was away when Micron shit the bed, but it traded down to about $80. If you go back and look, that was a prior low. And I do remember at one point saying on Fast Money or one of the shows that, we got down to a prior low. This should be a tradable bottom. So that proved to be the case. But I would not be buying Micron here right up against the 150-day. I think this is where Micron stalls. So, this is a bit revisionist, and I apologize, but I don't think it's breaking out here. And if you go back and listen to what they said last quarter, that was a disaster. And that's a disaster having traded levels about 160 or so not earlier this year, middle of last year.
Mm-hmm.
I'm going to do that for the next couple of weeks. So Micron's got issues here. Yes, it's bounced. I think this bounce is probably running out of gas right here, Dan.
I agree with you. What they had to say about consumer electronics versus AI was not particularly good. It's rallying off of AI hopes right now. We had Foxconn come out with some December sales that were much better than expected, and I think that was, that got that going. ARM, ASML, a whole host of other names in the semi space. All right, guys, we got to get to your chart of the day.
Do it.
Look at that graphic. Amanda just
did Amanda do that?
Yeah, she did. That's some pretty good stuff.
That font looks like something like I've seen that before. That font, that of the day. I don't know. It's like a movie or something. Nvidia in the danger zone.
Yeah. All right. So this is the chart that you laid out. Pretty fascinating stuff. As we speak, the stock is down nearly 7%. Now, you tell me, why would that be? Jensen Huang, the CEO of the company, had a prime spot at CES. It's a consumer electronics show that is out there in Vegas. He was the keynote speaker last night. Stock rallied into it, closed, I think, at a new all-time high or so. What's going on with those red circles, guy? All
right. So yesterday it closed at an all-time high. Excuse me. Today we made a new all-time high. So let's look at the red circles. Let's start back in March. Now, if you recall, the stock made an all-time high back in March. It had a huge reversal. Stock traded sideways. We actually pointed that out on Market Call, pointed it out on Fast Money. We talked about that key reversal formation. And by, I want to say, late April, early May, the stock had traded down some 35%. It subsequently got it back. We obviously gapped higher. Then you had the same formation in June, the second circle, a reversal, key reversal against a new all-time high. By, I want to say, early July, mid-July or so, the stock had traded down, I think 35 or 40%, maybe more, because I think we got down to about $80 on that August 5th low. Once again, we saw this in November, not to the same magnitude, but that was around when they reported earnings, I believe. You saw the subsequent move higher and then the give back into December. Today, though, is textbook, and it's doing it on big volume. We made a new all-time high today. We're trading where we're trading right now, 142 and change. if we were to close below yesterday's low, and I don't have that in front of me, that would once again be a key reversal day on big volume. And it would suggest a similar move that we saw back in March, back in June, and to a certain extent in November. You put a number on it, I think it's somewhere between 35 and 40%, and then you can put the price where it should trade down to. I am not a hater. I don't care one way or another. I'm not impressed by his crocodile suit. I think he does a masterful job of talking a good story. But at a certain point, the market's going to start to, I think, I don't know, maybe start to dismiss some of that rhetoric, and it's going to start to look at valuations and where it's trading and where it should be trading historically. So today is a critical day for sure, Dan.
I think those are little crocodile tears about that crocodile.
Oh, look at what you did there.
Hey, really quickly,
something that's just a Johnson again. That's akin to doing one push-up like Genzinger did at Intel on stage.
Yeah. So really quickly on this one, again, I'm not a hater either. I just think that the bar to jump over is getting smaller and smaller. So when you have, a low bar and not a big beat, the stock is not going to perform that great. They are having a financial, their CFO is speaking to analysts today. So it's interesting. I wonder if something has come out, guy, because we did see another leg lower in this thing from down 4.5% to down nearly 7%. Mm-hmm. But like we're going to have to hear, what does CapEx sound like from their major customers? 4 customers, 40%, Microsoft, Google, Amazon, and Meta. So let's hear about CapEx. Let's hear about their customers' use cases. Satya Nadella, the CEO of Microsoft, this was a few weeks ago on the BTG podcast. It's Bill Gurley and Brad Gerstner. He said they are no longer constrained as it relates to chips. Okay. So when you think about that, there's a lot of things coming together that maybe they're just not going to have the demand. Maybe there's more competition. Maybe there's just kind of less pricing power. So that was an interesting story to me. Again, probably the most important name in the Fateful Eight, but they don't report until late February. That's why all those other names are really important. They're big customers. All right, guys.
By the way, let's just throw up. By the way, Wavy McFly, and if Timmy or Amanda wants to put up Wavy's question, I think we just addressed it, but I want to make sure to sort of be respectful of the questions we're getting. Continue, please, Dan Nathan.
Yeah.
Trade.
Thanks, Wavy. All right. So let's do 2 things in the energy patch here. So, Guy, you got me looking at the XLE. This was on December 17th. We know the major components there are Exxon, Chevron, and Schlumberger. You wanted to take a bullish view on this. So let's just update this trade. So it was December 17th. The stock or the ETF was trading around $86 at the time. We were buyers of the 87.97 call spread in February. Cost about 2.25. Then the stock is up, a couple bucks, 2.25 or so. So it's 88.30 right now. This is in the money. This $10 wide call spread that cost 2.25 is now worth about 3.10. I think you stick with it here, Guy. You're targeting kind of that 150-day moving average, kind of as the first target. You get through there, then you have a double on this trade. So that 2.25 is probably worth.
No, I think you're right. And I'll say quickly, I missed the timing by probably about 4 or 5 trading days because, we basically cratered down, I think about 82.5, 83, but you've seen the turn. So, all right. So I missed the timing by a few days, but doesn't mean you missed the trade. And I think you're right. This thing should sort of trend back up to the moving average. And then we're going to start to see that if you do see a sell-off in some of these higher valuation names, where's the market going to find relief? I think it's going to find relief in the energy patch in the form of the valuation. So I think you're right to stay with this one, Dan. And if it gets to 5, then basically you have a double. You take half off, you're in the rest for free.
Yeah, and again, this is an administration that's supposed to be very friendly to the large integrated oil names, but demand comes in there, dollar strength comes in there. There's a lot of moving parts there. All right, let's look at the largest component. This is the Exxon, because this one sets up really interesting, Guy. I guess the chart doesn't look that different than the XLE, but rather than a long premium directional trade, I want to do a short premium directional trade. I like that 105 level. That's that support level that you see was a consolidation going back into last February or so. You saw the big ramp, you saw the consolidation, you saw new highs, and then you saw this thing drop like a lug, right through the moving averages, right through that kind of double bottom that we saw spring and fall and everything like that. So it's had the rally. It's gotten up towards this 110 level. So what do I want to do here? I want to make a bullish bet, but I want to do it with defined risk. And I also want to do it taking advantage of premium probably coming in, whether the stock goes sideways or goes up. And then I'm giving myself some room to the downside. So I want to look to sell a put spread. What am I doing here? When the stock was trading around 109 today, I want to sell the February 105 100 put spread. About $1.10 is what I will receive. I will sell to open one of the Feb 105 puts at $1.80. I will buy to open one of the Feb 100 puts at about 70 cents. So again, I'm taking in $1.10. This is how I make money on this trade. If the stock is between 103.90 and 105 on February expiration, I can make up to $1.10. I have a max gain of 110 above 105, and then I can lose up to 390. Now we're going to go through this risk reward here. You can lose up to 390 between 103.90 and 100 with a max loss of 390 below 100. But what am I targeting here? That 105 level, right? And this is where I want to kind of look to the deltas. So let me kind of take over here for a second, Amanda, and let me pull up Exxon. Okay, let me go to the options chain here. This is on my legend. I'm going to be a legend for you here, Guy. So I'm going to go
twice in one day.
Twice in one day. I'm going to go to February expiration. Look how easy it is to navigate that, right? So I'm looking at this 105 put. So right here, it's basically I'm selling it at 107. And if I'm looking at the 100 put, so this is basically costing $1 right now. If you were to sell that, you get $1 rather than, it says 103 here right there. And we were pricing up at 110. So that's how I look at a short put spread. That is a credit spread, right? And then I want to take a look at the deltas here. So the 105, okay, if I look at this, the delta is about 30%. Okay, so it's got about a 30% probability that the 105 put is going to be in the money. So I basically have a 70% probability that this stock is going to be above 105. At least that's what the options market is pricing right now. Now, they don't have dollar strikes, they have $5 strikes, but the 100 put is about a 13% probability that that's in the money. So here's what I'd like to see do. I can see the stock, if it goes sideways, if it goes down a little bit, but stays above 105, this is a trade that I have lots of different ways to win. I've also capped my risk, right? So how would I manage the risk if it goes through that 105 strike? I have room down to 103.90. The stock's trading at 109.25. That's plenty of room here. So if it was in that short strike zone where I'm losing money, let's just see how it trades. Let's kind of give it some time. Let's see the reasons why it goes down there. Let's see where all these other things. I just like the risk reward of this trade. When you're telling me that I have a 70% probability that this stock is above 105 on February expiration, this is how I want to trade options in this environment.
Yeah, and what's interesting about this is you're not selling naked puts, so you're not putting yourself out on a limb. You obviously have the protection with the $100 put, and obviously the risk in terms of what you potentially could lose outsizes the potential gains, but that is mitigated by the fact that probably have a 70% chance, to your point, of being right. And this is an interesting way. Again, we talk about creating synthetic dividends. This is an interesting way to do it with a stock that I think is going to start to trend higher from here.
Yeah. And again, what are we doing right here? We're kind of marrying some fundamentals. We're marrying some macro. We're marrying the technicals, and we're using the options to kind of put the, the odds in our favor. So I just like that. You're going to see us do a bunch of this stuff of late. I just think it's a good environment for that. A couple of weeks ago, we did a calendar. We'll probably, if we want to be bearish, look to sell it out of the money call spread, and you guys are going to see how you can kind of make money in an environment where you don't have to be so right. Like the stock doesn't, or the ETF doesn't have to go directly to your strikes for you to make money here. And you're going to see how that kind of at the money or that near the money thing that you're short decays. So that's the trade here, Guy. We covered a lot of ground today, man. We had the chart of the day. We had the calls of the day. We had an update on a trade idea from a few weeks ago. We got a new trade idea. What more could you ask for?
Can't ask for anything more. All you can ask for is a Ranger victory tonight at Madison Square Garden. By the way, a Madison Square Garden that you will be at,
yes,
with Carter Braxton Worth. So look for Dan there, buy him a beer. But that's it. We got a 5,000. Thanks for the questions. I tried to address a few of them. We'll get more in tomorrow. But enjoy the rest of the day and stay, keep a firm eye on that NVIDIA close. I think it's going to be extraordinarily important.
All right. Thanks, everyone. See you tomorrow.